Stop giving away your hard-earned cash to credit card issuers and banks. You often do this by paying unnecessary interest to credit card issuers and banks by not qualifying for their best rates because of less than stellar credit. How can you stop giving away thousands of dollars? We're going to address that question by diving into two areas. First, we'll talk about how and why you should avoid paying credit card interest. Then we'll address the strategy of improving your credit score to increase your chances of getting better interest rates on loans, as well as that coveted travel card you may be seeking. Credit card interest elimination. Let's agree that your goal must be to eliminate paying credit card interest going forward. I understand that you may have already run up a credit card balance. So we'll talk about how to address that. Can we just agree that there ought to be a mandatory course for high school seniors and college freshmen on how to manage credit? We teach kids how to solve complicated mathematical equations, but they often lack a fundamental understanding of how to manage credit as they prepare to enter the workforce. Sure, parents need to pick up the slack here, but let's be honest, many adults would benefit from this same type of credit awareness course. There are currently many tools out there, but if you don't know what you don't know, you're unlikely to seek out any type of credit education until you get into trouble. Credit card companies would love nothing more than to have you make the minimum payment each month, which they conveniently calculate for you on your monthly statement while they charge you an insane amount of interest on your remaining balance. If you currently have a balance but you can't afford to pay it in full, please pay the maximum amount that you can afford, which should be significantly above the minimum amount. Have you looked at your credit card terms lately? Credit card interest rates are now reverting back to their all-time high of the early 1980s. Today, they range anywhere from 16% to 29% APR. That is insane. What other investment can you expect to earn a 16% to 29% annual return on your investment? I'm earning a mere 4% interest on a high-yield savings account, and that's considered good. Yet folks are willing to give away 16 to 29% in interest to credit card companies. Folks, it's time to stop the madness. So let's talk about how we got here. You were likely in college when you got your first credit card. Perhaps you were approved for a $1,000 store credit card limit from the Gap or a similar card. They then sent you your first bill, which stated that you have a minimum payment of $25 due. Meanwhile, you had a $300 balance. So to repeat, you have a balance of $300, but the credit card company is only seeking $25. You likely said to yourself, "This is friggin' awesome." That was your first relationship with credit, where you were conditioned to view it as charge now and pay the minimum amount due later. How do I know this? That was me. So I'm sharing so that you may learn from my mistakes. I got lucky to have a good career where I started paying my balance in full every month. Not because I bought into the concept of paying no interest. I just happened to have the cash on hand. However, once I became financially savvy and ran the numbers, I changed my relationship with credit cards and vowed never to waste money paying credit card interest again. For newbies to credit, you must believe from day one that you should not borrow money from a bank while paying interest to manage your day-to-day living. This is essentially what you're doing when you charge now and only pay a portion of your balance. It takes discipline. Your mindset is to essentially treat a credit card like a debit card. You're already fully aware that you can't use your debit card if the funds aren't there. If you apply the debit card mindset to credit cards, you will be on your way to earning great travel rewards and cashback benefits. Now, for those of you who have had credit cards for a while and are seeking to change your mindset, it will be harder to unlearn the bad habits that you've accumulated over the years. However, if you're in that group and you're watching this video, it means you're ready to make the switch and begin earning credit card rewards for amazing travel and cashback benefits. Going forward, do not charge an item if you don't have the cash on hand to pay for it immediately. Save up for the item, then make the purchase with a credit card to earn the rewards. Then pay it off in full before the due date. If you're seeking to repair your credit, but you've already accumulated a large balance, pay the maximum that you can afford, and please do not pay the minimum shown on your statement as a guide. Your payment should be as close to the entire balance as possible. Eliminating credit card interest will quickly free up cash to use in other parts of your life. Number 2, credit score improvement. I'm gonna get into some granular details about credit scores, so bear with me, it'll all come full circle in a moment. The credit score used by most lenders is the FICO score, which is calculated by using inputs from your credit history as reported by the lenders. Some of you may sometimes see another type of credit score called Vantage Score. Again, this too uses data from your credit history. The 3 credit bureaus which should matter to you are Experian, Equifax, and TransUnion. For the rest of this video, we'll focus on the FICO scores that range from 300 to 850 for the basic score, but within FICO itself, there are several versions. FICO score 8, FICO score 9, and even a FICO score 10. We have no control over which score credit card issuers are going to use. To make matters worse, there are industry-specific scores within each version. For example, there's a FICO auto score used by the car industry, and a FICO bank card score which you can expect credit card companies to use. It all sounds really complicated, right? That's intentional. So now that you know, you can forget about it. Just be sure to establish your baseline score by requesting a free FICO score and report. Each credit bureau will offer at least one free credit report each year. For example, after establishing a free account with Experian, they'll provide you with updates to your FICO score several times a month. It's also routine that credit card companies will make available a version of your credit scores through their online portals. Focus on achieving a minimum FICO score of 761. The average credit score in the US is 714 as of 2022 and is trending upwards. Now don't be fooled by this number because it varies greatly by age group. As you might guess, the older the group, the better the FICO score. A 761 FICO score is not a requirement to be approved for a credit card, a car loan, or a mortgage. However, it improves your chances of qualifying for the best rates, as well as being approved for any other credit cards which you covet. Additionally, FICO scores dip whenever you apply for new credit, so having an average score of 761 keeps you in safe territory. Now let's look at the components which make up your FICO score. Payment history, that's 35%. Credit utilization is 30%. Length of credit is 15%. Amount of new credit is 10%. And credit mix is 10%. Let's start with payment history. That is 35% of your FICO score. This is the single largest impactful FICO category. Folks, you need to pay your statement balance on time. If not, you'll be charged interest and you'll be hit with a late fee. And you will quickly tank your credit score, which you're working so hard to improve. Late payments stay on your credit report for 7 whole years. No one is perfect, and there can be extenuating circumstances which have caused you to miss your payment by the due date. However, if you make your payment before the next statement closing, it will not be recorded as a late payment. If you're someone who normally pays your statement in full monthly, if there's a one-off hiccup where you miss your due date, just call the credit card company and ask for a credit for any interest charged due to missing your payment. In most cases, they will approve the statement credit. Number 2, credit utilization. This accounts for 30% of your FICO score. This is the amount of reported total credit you've used up when compared to your combined credit limit across all cards. Treat this category very seriously because it is heavily weighted. My rule of thumb is to hold your utilization to under 10%. I see no value in going with some published guidance to hold this number under 30%. I would argue that carrying a large balance increases the likelihood that you will end up paying interest. The strategy I use to keep my utilization in check is to establish a cadence for paying my credit cards on a weekly basis. Remember, this channel is to let you know what I do and not just talking about a theoretical approach. Paying weekly is by no means a requirement, but it greatly reduces the risk of me ever missing a payment. And it ensures that when my statement closes, that my utilization will be low. Feel free to pick and choose what works best for you from what I do. If you're not able to pay weekly, that suggests that you're spending money that is not in your bank account, which violates our agreement that you're to use a credit card like a debit card. If you're able to nail number 1 and number 2, you'll greatly improve your FICO score because they account for 65%. Number 3, length of credit. This accounts for 15%. The rule of thumb here is not to close your oldest credit cards. However, in general, this category automatically improves as you mature in your credit card game. Number 4, amount of new credit. This accounts for 10%. Be sure to apply for credit strategically. Each time you apply for new credit, you should expect what is known as a hard pull of your credit history. These credit inquiries stay on your report for 2 years. This category is just 10%, and any dip in your FICO score as a result of a hard pull quickly rebounds in a few months. Chase has a 524 rule, where you won't be considered for a card if you've opened 5 or more credit card accounts in the last 24-month period, regardless of your FICO score. If you care about the Chase setup, then you'll definitely want to consider how often you establish new credit card accounts. For this reason, I've been somewhat dismissive of Chase as a credit card issuer, because the general public is often not aware of this, which means that consumers end up with a hard pull, a denial, and then a dip in their FICO score. I believe that Chase should list this requirement on their website so that consumers can make an informed decision. I don't expect that to happen anytime soon. Number 5, credit mix, which comes in at 10%. Lenders want to see that you have a good mix of revolving credit versus installment credit. Essentially, they want to see that you have a good mixture of credit cards, car loans, and potentially a mortgage. I recommend that you largely ignore this category and apply for loans and credit cards as your lifestyle warrants. This category will take care of itself. There's another category that doesn't have a percentage weight, but it does impact your FICO score. It is derogatory information in your credit history like bankruptcies or foreclosures. Unfortunately, you'll just have to wait for such items to roll off your credit report, which could take up to 10 years in some instances. So you want to desperately avoid such measures when possible. Now that you have this information, I hope that you will take the necessary steps to manage your credit wisely. I hope you found this video informative and that you appreciate my personal experience on how I manage my credit. Be sure to like, subscribe, and do share this video with anyone you believe may derive value. Be sure to also head on over to my travel channel where you'll get to watch my musings as I travel East Africa for the next 6 months. Take care and be good to one another.